Welcome to the Skilled MBA Finance Case Study Series. Today we delve into a pivotal transformation in West Virginia's pension fund strategy. Historically anchored in bonds, the state's pension funds prioritized capital preservation, limiting exposure to market volatility, but also capping potential growth. That changed with the 1997 amendment, which permitted up to 60% investment in equities. This shift marked a strategic inflection point, opening the door to greater returns, yet introducing the challenge of managing increased volatility and market risk. The move demanded a sophisticated approach to asset allocation, prompting a fundamental reevaluation of investment strategy in a traditionally conservative financial environment. This case study illustrates the complexities of balancing growth with stability, a critical concern for public fund managers and policymakers navigating modern financial markets. West Virginia's pension strategy, historically bond-focused, faced a turning point with the 1997 constitutional amendment. This change permitted up to 60% equity allocation, introducing potential for higher returns but also increased risk. The state had to weigh the benefits of diversification against the stability of its traditional approach. Craig Slaughter, executive director of West Virginia Investment Management Board, confronted a critical choice: continue the bond-focused strategy, adopt a diversified approach with equities, or balance both. This decision was pivotal in addressing the state's pension fund challenges, requiring careful consideration of risk, return, and long-term financial health. West Virginia's pension system faces a $4.3 billion unfunded liability, highlighting a critical gap between promised benefits and available funds. The traditional bond-only strategy yields a 5.2% return, falling short of the 7.5% required to address these liabilities and ensure long-term solvency. A strategic shift is imperative to meet these financial obligations. Modern portfolio theory emphasizes diversification, blending stocks and bonds to enhance risk-adjusted returns. This approach contrasts with a bonds-only strategy, which often falls short in addressing unfunded liabilities. By diversifying, West Virginia can potentially achieve the necessary 7.5% return, ensuring long-term pension solvency while managing risk effectively. The efficient frontier maps diverse stock and bond combinations, each with a unique risk-return profile. It shows how West Virginia could achieve higher returns without proportionately increasing risk through strategic diversification. This approach maximizes expected returns for a given risk level or minimizes risk for a given expected return. West Virginia's conservative financial culture prioritizes guaranteed benefits, resisting change despite potential higher returns. Political accountability concerns arise from short-term equity investment losses, risking backlash. Fiduciary responsibility demands balancing risk management with growth to secure retiree benefits, ensuring future obligations are met. Neighboring states like Pennsylvania and Virginia, with equity allocations of 45% and 52% respectively, achieved higher 10-year returns and funded ratios. West Virginia's 0% equity allocation resulted in a lower 5.2% return and 65% funded ratio. These benchmarks highlight the potential benefits of moderate equity inclusion for improved financial health. Shifting 10% from bonds to equities can boost expected annual returns by 0.4 to 0.6%, potentially closing funding gaps faster. While volatility increases, correlation benefits lower overall risk. Over 30-plus years, equity risk premiums offset short-term volatility, enhancing growth. Higher returns could reduce state contributions by 400 to 600 crore rupees annually, alleviating budget pressures. Navigating the transition to increased equity allocation involves building internal expertise, developing manager selection processes, and creating risk management frameworks. Consider strategic timing, dollar cost averaging versus lump sum, market valuations, and phased timelines. Establish transparent reporting and effective communication strategies for stakeholders to ensure a smooth transition. Explore asset allocation fundamentals by applying modern portfolio theory and efficient frontier concepts to institutional investment challenges. Evaluate risk-return trade-offs using both quantitative metrics and qualitative factors. Understand public finance dynamics, focusing on the constraints of public pension fund management. Develop strategic implementation approaches, balancing academic theory with operational realities for effective portfolio transitions. The decision matrix highlights 4 strategic options: maintaining the status quo with 0% equity, a conservative shift to 20% equity, a balanced approach with 40% equity, and a maximum allocation of 60% equity. Each option presents varying financial impacts, political risks, and implementation complexities, illustrating the multidimensional trade-offs beyond mere return calculations. Historical data shows diversified portfolios offer superior risk-adjusted returns over time. Even conservative equity allocations can enhance West Virginia's pension sustainability without excessive risk. Solely relying on bonds may seem safe, but poses long-term risks if returns fall short. Effective risk management must consider both volatility and shortfall risks. Risk management in institutional investing is complex, requiring a balance between short-term volatility and long-term shortfall risks. Public fund managers must navigate political and cultural landscapes, combining financial acumen with stakeholder management. Effective change management involves strategic planning, transparent communication, and gradual implementation to foster trust and showcase value. Skilled MBA provides comprehensive case studies and educational resources in institutional finance, asset allocation, and public fund management. Our materials integrate academic theory with practical application, catering to finance students and investment professionals seeking to enhance their expertise. Thank you for exploring this finance case with Skilled MBA. Mobile plus 91-87553-00795 email. support@skilledmba.com. Website www.skilledmba.com.